gentlemen, may I have your attention, please? The show starts in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, go.
Hello, and welcome to a new edition of the Grow Giver podcast with Stephen Crawford, Justin Hoke, and Malcolm Finlayson. We're so excited that you guys have joined us here today for this very special show. We are having with us, although she hasn't arrived yet, very busy woman, Veena Jetti, multifamily princess. Is that a good title? In fact, she's just gotten here backstage, so I'm going to go ahead and bring her up now. Hey, Veena, how are you doing today?
Hi, guys. I'm sorry I'm running a few minutes late. I actually sat in the waiting room screen, which shows you how tech savvy I am. So I apologize.
Well, it is such a privilege to have you on here. We are super excited for today's show. And we're so excited to give the folks here in the Grow Giver community an opportunity to get to know you a little bit better. And hopefully we can ask you some questions and have some of your amazing knowledge poured out on us. So without any further ado, I'm going to hand you off to Steve and take it away, brother.
Hey, Veena.
Hello. Thank you for having me, guys. I appreciate it. I'm excited to be here.
Yeah, we're excited to have you on. We've been talking about it for this whole week, and we were talking about it last night, making sure everything was good to go.
Oh, no pressure.
Yeah, we've got ourselves prepared. So
we felt the pressure. We don't think you should feel any.
I'm very excited. Thank you for having me.
Yeah, I'm going to jump right into some of these questions.
Do it.
You know, I'm just watching some of your content like on Instagram, and I see you have a pretty recently come out with your own YouTube channel.
Yeah,
and I was actually at the Clever Investor that I rewatched it again. And I was just looking at some of your stuff and thinking about where you got started. Because a lot of our viewers are people who are kind of new to real estate in general. So one of the things I'm super curious about was you said you made a jump from single family. You're doing a lot of single family. And you made a jump to multifamily. And can you go into that and maybe some of the reasons why?
Yeah, I didn't know any better is really why I started in single family. I thought everybody had to start in single family. I didn't know that I didn't know that regular people could buy multifamily assets, which is so crazy because I grew up in a real estate family. I graduated college with my degree in finance. And then I worked in corporate real estate for years. And even being in some of the largest real estate firms in the entire world, right? I'm talking about multi-billion-dollar portfolios. I didn't know that you didn't have to be like Steve Jobs or Oprah to buy multifamily assets.
Right.
I thought you had to have millions of dollars. I thought you had to have all of it liquid, and it didn't make sense to me. And so I'm actually really upset that I didn't know about it years ago, because imagine where I would have been had I known this to begin with.
Right. And so and I guess what is the reason that you think multifamily is a better avenue to go than single family? Maybe some of those reasons that you decided to make that leap from single family, because I know you were buying not just a little bit of houses, but you were buying houses several a week. So
a lot of houses a week, and it still wasn't enough houses a week, honestly. So I don't know, do we have hours and hours to go into all the reasons why I love multifamily?
Sure, if you got hours and hours, we'll listen for hours and hours. How's that?
No, but really scale. It's that simple. That if I had to sum it up in one word, it's scale. You cannot get to scale buying single family homes unless you're buying entire neighborhoods at a time, like Blackstone is, and like some of these larger private equity funds are. But the reality is to get to that level is just much more complex and difficult than you think. So to get to scale, it's much easier to buy multifamily. Secondly, you can finance it easier, which is really counterintuitive. So people that are listening that have never done a deal before, have only done single family deals, it is so much easier for me to finance a $50 million deal than it is to finance a $600,000 deal. And this is actually a true story. I know it sounds crazy. This is a true story. So I was buying a house in my neighborhood, and it was, it wasn't a crazy price. It was like 630 or something like that. And it's a nice house, but under $1 million. And I was buying that house. This was earlier this year. And I really thought I was going to have to pay cash for it or do a hard money loan or something, because conventional loans, they did not want to loan me the money. It's not because I have bad credit. It's not because I have like no income or anything like that, but it's because my debt to income ratio did not fit what they wanted to see, because we don't own anything, right? Our trusts own everything. We control companies that own things, but we don't own anything. And so they're looking to Veena Jetti to see, Veena Jetti, can you repay this loan?
Right.
When you're buying in a trust. And it was the craziest thing. It got to a point where they were like, okay, listen, in order to buy the house, you have to pay off. I have my mom car, right, that I had. It was like the end of the lease. I wasn't sure if I was going to buy it or so. Like I was just kind of being a little bit lazy and dawdling on it, if I'm being honest. And what they said was, they were like, okay, you just have to pay this car off and then we'll approve the loan. And I'm like, this is the stupidest thing I've ever heard of.
Right.
But okay, fine. And then I'm thinking about it, and I'm like, okay, I have the money to pay this car off, which it was like $50K or something. It wasn't like an astronomical amount, but still. And I was like, what do everyday people do? Most people cannot just put another $50K into the car. And then the house, we paid over appraisal. I knew we were paying over appraisal, but I wanted the house for the location. It was for my family, like my in-laws, to live in. So that was really important to me. And so I brought extra cash to the table, but they knew our situation. They still didn't want to finance me. And that was on a single family home purchase. Do you know how many times a multifamily lender has asked me to pay off a vehicle to finance a $50 million deal? Exactly 0 times. They do not care. They don't look at my bank accounts. They don't look at all of my documents. They don't ask me to write a letter explaining anytime there's a deposit over like $10,000 or whatever the rule is for conventional lending. They don't care about all that. And it's because they look at multifamily as a business. They know it's an investment. They don't know that the single family home is an investment, or that's how we view it. And so it is infinitely easier for me to finance larger deals, which is another reason I love multifamily. And then the third reason I'll give you is the last one, and then I'll stop blabbering about how amazing multifamily is. The third reason is really because multifamily allows for operational efficiency. So it's kind of a subcategory of scale, right? Not only do you get to scale doors, but now you're sharing common expenses. So I have one roof. I don't have 200 roofs when I buy a 200 unit property. I have one roof. All of the asset splits that cost. I also don't have as much vacancy risk. If one tenant moves out on a 200 unit asset, great. I want them to move out because I want to have some units available to see how high we can push rent, or see what the market's willing to do, or renovate, or whatever my business plan is. On a single family home, if you have one tenant that moves out, it's kind of a problem, right? So I just think that efficiency, scale, financing, all of those are really the reasons why I love multifamily.
Yeah, those are good reasons too.
Really great reasons. And I love what you said about the financing. I think the banks are set up to basically they're part of the system, and they keep the individual in place. Oh, we want people at W2. We'll let them grind. They're not going to think outside the box. I mean, it's
Yep.
No.
Yeah, and I mean, there are products available to do that, but there's only so many times you can utilize those products before the bank goes, wait, you are way too much risk for us to take on.
Yeah. No,
I-
I'm sorry, Malcolm. Go ahead.
No, I wasn't going to say. I was just sort of laughing at the idea of you being way too much risk. So,
It's true.
Can
They'll
you,
tell you.
with the multifamily deals, like there's kind of like you do kind of a value add model, right?
Mhm.
Can you kind of give like just like a brief description of what that looks like what a multifamily deal looks like and what the goal is?
Yeah. So it could be a variety of things. It depends on the assets, very asset specific. So when we go into an asset, the first thing we'll do is an amenity audit. So we want to know what amenities are on the property. Is there like a playground? Is there a pool? Is there a gym? Is there a clubhouse? Are there workstations? Is there a valet trash? Is there reserved parking? We want to look at all of those things. And then we want to understand what the interiors look like, right? So do we have granite countertops? Do we have stainless steel? Is it laminate flooring? Is our washer and dryer in the unit? Is it painted like brown from the 80s? Or, I bought an asset last year and it was Kermit the Frog green, which, okay, like in the 90s, I guess that was cool, the accent wall, lime green. Okay. But that is not something that would really move a buyer to want to live in this fabulous community here, right? So those are all things that we're going to look at on a case by case basis. How much we allocate to the asset or to each unit renovation really depends on two factors. One, what is our current portfolio doing? What are the real numbers that we're seeing? We want to peg to that plus a little bit more to allow for contingencies or to allow for there to be a delay in materials or materials unavailable and we have to switch to maybe a more expensive product, right? So that's one. And then two, and this is the most important, we want to look at what our comps in the market are doing. If we are in an area where nobody else has granite and stainless steel, that's probably not an expense we want to spend because there's a very good chance that we're not going to be able to get the rent equivalent to the ROI that we need to see on those types of additions. So you want to be very careful that you're not over improving for the area. And this is actually a mistake a lot of new investors make. So they'll go into an asset and be like, oh my gosh, this asset we can charge $1,500 in rent after we renovate. And then we can add an amenity fee and a valet trash fee and parking fees and this fee and that fee and pest control and all these things, right? So that by the time it's all said and done, their pro forma now depends on them getting $2,000 a month in rent. Well, in order to have enough tenants to qualify for a $2,000 a month rent, conservatively, you need to have a 3x income on that. So if you're going to pay $2,000 a month in rent, you need them to make $6,000 a month. That's $72,000 a year. If you're buying in an area where the average median income is $50,000, you're going to run into one of two major problems. Either one, you're not going to be able to get the rent that you're demanding, or two, so you're going to have increased vacancy, or two, you're going to get the rent that you're demanding, but you're going to have a lot of bad debt and delinquency because no one can actually afford it. You're qualifying people that really have no business being qualified.
Right. And so with all that, I mean, all those like raises in like the rent and all that, is the goal is you're using that to raise that NOI, right?
Correct. Yes. So that's in the forced appreciation side of the equation, right? So we do value add. We want to take the asset from value A, improve it, add more income, and then take it to value B. So you said there's a lot of newer investors on here, yes?
Yeah.
Do you mind if I just run through how we get to pricing a little bit?
Yeah, no, it's your show.
Okay.
Go for it.
Awesome. So multifamily, like I said, the bank is going to look at it like a business, which is how we want to look at it too, right? Because it's a business. It is not just real estate. It's a business within real estate. And so to get to the market value of what the asset is, what we're going to do is we're going to take the NOI, which is the net operating income. And if you guys have pen and paper, I would write this down, right? So your net operating income is just simply your revenue minus your expenses before you pay any other cash, right? So you're going to take your NOI and you're going to divide that by the current cap rate in the area. So let's say that we're trading, and I'm going to pull out a calculator here so that I'm not doing all this crazy mental math, right? Let's say that you have $1 million in NOI. Okay. And let's say you're in a 4 cap environment. So you're paying a 4% cap rate. You're going to pay I don't know if you guys can see, you're going to pay $25 million on the asset, right? Now, let's say that we can go in and we can increase each unit. Let's say it's a 100 unit property, right? So we're going to take 100 units, and let's say that we increase the rent and fees, et cetera, by just $300 per month. Okay. So it's $30,000 a month times 12 months means we've taken the NOI, right? The NOI is going up by 360,000. I'm sorry. I don't know why it's blurring, but it says $360,000. Now, to see how much appreciation that we've caused just by increasing each unit by $300 a month, we're going to divide that by the same 4 cap, and we're going to get $9 million. So that means by increasing the rent and fees of every unit on that asset from the time we start to the time we exit in a 4 cap rate environment, we've added $9 million in value in addition to the $360,000 of cash flow. So, which is mind boggling, right? And that's why multifamily historically has such strong returns, and it's the lowest relative risk for those same returns.
Yeah, it's crazy to think about, like like you're saying, the $360,000 a year can raise the value of a property by $9 million.
Exactly. And, look at it even in smaller terms, right? Let's say we just increase it by $5 a month. Okay. We have 100 units. Right. We're increasing it by $5 a month. That's $6,000, which is going to add $150,000 in value. Whoa.
Yeah.
Guys,
so,
this is
so
like,
crazy.
This is the hardest thing I've done all day, is trying to show you guys my phone.
It's because you got the blur background.
Right.
I don't even know. I didn't even know what I was doing. It's a wonder I even made it into here.
No, that's great. Hey, just to ask a question about that. I know when I first got into multifamily, the cap rate sounds like a magic number. It just comes out of nowhere. For all of our viewers out there, could you go into a bit more detail where the cap rate comes from? Because it is sort of like mystical at first.
Yeah. So the equation that I gave you, it's like a 3-pronged formula, right? It's your NOI, your market value, and your cap rate. So to get the cap rate, we inverse it, right? So we divide NOI by what you're paying for. So if you're paying $10 million for an asset and it has a $500,000 NOI on the T12, the trailing 12, you're gonna take 500,000 divided by $10 million. Is that why I said $10 million? Then that means you're paying a 5% cap rate. Now the key is, like, you might look at a deal and be like, Veena, I don't actually know if 5% is a good cap or not. Really, what you're gonna look to is, what is the market doing in that sub-market? So a 4 cap in today's market on a Class B institutional quality value add deal is not unusual. There was a time not that long ago where like 3.5 cap was okay and acceptable. But what you're going to do is you're going to start looking at different assets. You're going to talk to different brokers as you hear whisper prices, as you hear what you are expected to pay to win a deal. You can start calculating what kind of the average cap rate is in the area. And then you can also calculate what your cap rate, your going in cap rate, is going to be by just simply dividing the NOI by your purchase price. So in this assumption, we utilize what we know we're paying for the asset as our fair market value. We assume that we're paying fair market value.
Thank you. That helps.
Of course.
Now, there's a lot going on when you're buying like a multifamily, like a lot more than, buying like a house or something like that. So it's more complicated.
Yeah.
And you hear people say, multifamily is a team sport, or it's like, it takes a team. Could you maybe go into a little bit of what like a team would look like? Maybe like what the different players in a team would look like?
Yeah. So you're going to have 3 main prongs, and keep in mind too, there are many roads that lead to Rome. So this is not by any means the only way to do it. It's just going to be kind of a general setup that most people are going to follow to some degree, right? So you're going to have 3 main prongs. 1 is going to be your acquisition side. 2 is going to be your capital stack. And 3 is going to be your operations, your execution team, right? So within those, then there's going to be like 100 different subcategories. And these are not different than single family homes. It's very much in line with that. The difference really is probably going to come more on the capital stack side, because you are going to have kind of a subcategory in there of a KP or a key principal, loan guarantor, et cetera. So that person is going to have to come in, or maybe they're already on the team, but they'll have to have certain net worth and liquidity requirements, experience requirements to qualify you for non-recourse lending.
And like, you hear the term like operator. Sometimes I've heard that term. Could you maybe like describe what that means? Like, what is a multifamily operator?
Yeah. So I actually, when I introduce myself, I say I'm Veena Jetti. I run Vive Funds. We're large multifamily owner operators. The reason being is we are not just the equity in the deal. We don't just own the asset. We also operate the asset. So we're hands-on. We're day-to-day with the management. It's another term for saying an owner. You could easily say, oh, we're just owners. But if you're trying to distinguish that you are actually executing or part of that execution process, that's the operator side. But it's probably really not that important to say it or not say it. People probably don't really care that much, to be honest.
All right. And they're like a several. I'm sorry, Malcolm. Were you going to say something?
No.
Oh, okay. I saw there a couple ways you could break into multifamily. You could, we're kind of talking about like the active investing side, where you would be, trying to hunt down deals, or you'd have like some sort of, like we were talking about, positions in like a team where you maybe you do this, you're broker outreach, you're this guy, you're that guy. But there's also like passive. Could you maybe go into like what passive investor in multifamily is?
Yeah, so the passive investor in multifamily is easily the lowest barrier to entry, because you don't have to have any qualifications, any experience, any time. All you have to do is decide that you like an asset, you like an investment, and then write a check into it. Now, the big asterisk and caveat around that is you want to make sure you're vetting your sponsors appropriately. You want to know who you're investing with. You want to understand the risk, because like every investment, there is risk, and you want to understand that and make sure it's right for your portfolio as a passive investor. You also want to make sure that your strategy is aligned, because what happens is on a multifamily asset, a passive investor relinquishes control to someone like me, right? So my passive investor writes me a check for whatever, $100,000, $1 million, it doesn't matter, right? Whatever the amount is, even $1, right? They're my passive investor. They're relinquishing entire decision-making and operational control to me. So I, as the active sponsor, am saying, this is when we're selling, this is what we're charging for rent, this is how much we're going to push occupancy to, we're going to refinance, we're going to distribute cash flow, everything and anything. We're going to put purple on the walls. Like, all of that is a decision that I make. Our LPs, our passive investors, limited partners, they're all interchangeable. Those people do not get a say in that. So if you're somebody that wants to have the control, that's not going to be a good fit for you. But what's really great is if you invest passively into a deal, you now own equity into a deal. If you invest, and I should caveat this, if you invest passively into an equity position on a deal, you now own part of our property, right? So we just bought an asset in Charlotte, North Carolina, 408 units. It was a 9-figure transaction. All of my LPs own a fractional percentage of that deal now, right? And so when they go and put their SREO out, their schedule of real estate owned, they're going to put that asset on there in a fractional capacity. I mean, it's going to be obvious to the bank that they don't own a 9-figure asset singularly, but they do own fractional shares in it. So what happens now is you now start gaining instant credibility behind your name, because you say, listen, I already am invested into X, Y, Z. I've done this. This is my experience. And now the bank looks at you and says, oh, okay, Veena, it looks like you kind of know things about real estate. Great. So that's why a lot of even active investors start as LPs in deals. And then as an active investor myself, I actually invest into other people's deals, because I want to get diversity across different deals, but also I want to maximize my tax benefits by being invested in multifamily.
You mentioned like vetting, like the the people you're investing with. If you're going to be a passive investor, and that's like pretty important. Could you maybe give like a couple of ideas of what you would be looking for?
Yeah. So the number one question that if I could only ask a sponsor one question and no other questions, the question I would ask them is, tell me about a time where things did not go right and how you handled it, right? Like, what mistake have you made and what happened from that mistake, right? What was the result? What did you learn? And the reason that that is the question I would ask is because it's going to tell me a few things. One, it's going to tell me if they say, hey, like, there's never been an error or mistake or everything's always gone according to plan. Either you are lying or you haven't been in business long enough to know where the pitfalls are. And I don't really know which is worse, right? So that's first and foremost. Then when they tell me what happened, what I want to hear is the follow-up is what they've learned. How have they changed it so that I, as an investor now, am not going to face those same issues from the past, right? And what have you done to mitigate this risk so it doesn't happen again? And I want a thoughtful answer, and I want a well-planned answer of how they mitigate risk. I also like to ask sponsors, or when I'm talking to passive investors, I like to talk to them about realistic return expectations, right? So I'll get investors a lot of times, and I'm sure you guys are probably getting this as you're embarking on a raise too, but you're going to hear, oh, but Veena, your deal is like a 12 to 15% IRR. I have this other deal that I'm going to get a 30% IRR. And I'm like, let's back up for a second here. Let's talk about what is the asset class? And they'll be like, oh, well, it's like new development in the middle of Wyoming. And I'm like, well, there's significantly more risk in that than buying an asset in the middle of Atlanta or Charlotte or the Research Triangle or wherever, Dallas, right? So the first thing you're going to say is, guys, this isn't a realistic return expectation. If I put those numbers out, you should run away from my deals because it means I've been way too aggressive on my assumptions. I cannot defend them. And then the second thing is, these are pro forma numbers. It's really important to understand that. That does not mean that they are going to hit every time. That does not mean that that is what they are going to deliver on. So these are just expected numbers. This is what we think we can do. And you'll want to ask more questions around that. Like, okay, well, what have you actually been able to deliver? What have you seen on your other assets? Where have you actually ended up? Because that's really going to tell you, do they have a history of being conservative, or do they always overshoot and then underdeliver? You want a sponsor that's going to underpromise and overdeliver to your investors. And so that's another question I like to ask. And then I personally am always asking about the tax scenario because I care about that a lot. Many investors won't care about that as much as I do, but a lot of them will. And so, that is going to be a question that you probably will want to ask if it's important to you and your portfolio.
Yeah, exactly.
Now, we kind of touched a little bit on raising capital, but I wanted to kind of ask a couple questions on that. Like a couple of things that was wondering about is maybe you could go into what an elevator pitch is.
Yes, the elevator pitch. It's like your 30 to 60 second pitch that you're going to be able to say at the drop of a hat to anybody and everybody about what it is you do, right? So what do you do for a living? Hi, I'm Veena Jetti. What do you do? And it's going to be the 30 to 60 seconds that you respond that's going to intrigue them. If they are interested in this, they're going to ask you follow-up questions. And it's going to tell them exactly what you do clearly and concisely so that someone not in real estate can understand you.
Yeah. Exactly. Do you have an elevator pitch you could give us?
I do. So, okay. My elevator pitch usually goes something along these lines, right? Hi, I'm Veena Jetti. I'm a large multifamily owner and operator with a focus on Class B value-add assets in the Sun Belt. Essentially, what I do is I put together groups of passive investors to get double-digit returns on their investments. Think of me kind of like the Groupon of multifamily investing. I put together groups of people to have fractional interest in these assets because you can't necessarily buy a $100 million asset on your own, but my investors can because they come together and it's a collective buying for that.
Yeah, that's good. And I think that like when you start to hit that like double digit returns, that like makes people like, oh, Yeah. Okay.
Yeah. Yeah, it's the double digit returns, and that's usually where I'll get a question of, oh wait, how do people do that? Or the everyday passive investor, so I don't have
Right.
to take a call about a leaky toilet or a roof caving in. What?
Yeah.
Yeah, exactly.
Um,
You talk about all this, all the, and so everybody knows, I'm actually invested with Veena in her Charlotte deal, and so I've had a chance to meet Veena before. And it's always a pleasure.
Likewise.
Thank you. But when it comes to what you're all saying, for those that don't know it out there, I think the key document that investors should be looking for is the OM. And I guess rather than me butcher how to describe it, could you just go into that a little bit so people understand what they should be looking for and in a document like that?
Yeah, so there's actually two documents that are really important to passive investors, right? One is the OM, like you said, and that's the first document. That is essentially a marketing deck, a slide deck, a pitch book, pitch deck. It's called like all different things. All it is it's pretty. It highlights what's great about the asset. It's your business plan. It'll have general details. I like to think that by the time an investor sees my OM, they have about 70 to 100% of their questions answered by the time they read it. After that, they might need, one or two clarifying questions, follow-up questions. That's fine. But if 70 to 90, 100% of their questions are answered, then it's done its job. The second really important document that you are going to want to see if you are a passive investor is a PPM, a private placement memorandum, right? So you need to make sure that you have that document, because that is what tells you as the investor what the whole entire deal is going to do, how it's going to operate, what the risks are, how it's going to be distributed, what the sponsor's fees are. All of that stuff is going to be included in the PPM. And that is what you need before you wire funds. I tell investors all the time, make sure you have signed documents before you wire funds. And inevitably, I always have investors that wire me funds. And I'm like, Jennifer, you didn't sign your documents and you just sent me $100,000. And she's like, oh yeah, okay, I'll get to it. And I'm like, no, this is a bad habit to get into, because you don't know what I'm going to do with that money if you don't have documentation behind it. Like, what if I'm a Nigerian prince somewhere that's, won the lottery, you don't know. And, they'll be like, Veena, I'm seeing you for lunch next week. We see each other every 2 weeks. What are you talking about? Like, I know, but it's a bad habit. Get into good habits, because me, I know what I'm going to do, but I don't know what the next person you invest with is going to do.
Yeah, absolutely.
It's true. It's a true story. Every single time, I always have this happen with at least one or two investors.
Yeah, I'm the other end of the spectrum. I'll read every last line of the contracts, and
yeah. I mean, I have those too. I prefer investors that ask, thoughtful questions and that really try to understand it, because the more you understand up front, the less surprise there's going to be as we operate. Because the one thing I can guarantee anybody in this space is there is no asset that you are going to go into knowing all of the answers. There are going to be pitfalls. There's going to be pivot points. There's going to be, oh shit moments, for lack of a better word, and it's part of the game. And it's the reason why not everybody does it, is because those things are hard to overcome. But if you have investors that understand that this is normal, this is what's going to happen, it's a much easier conversation as things are shifting in the asset itself.
Yeah, no, I appreciate that. And from my perspective, for those that want to learn out there, when I invested with you and I'm reading all your documentation, going through it, all the detail, and I was the one with in your deal with Pace Morby, and Pace actually flew us out to Charlotte to meet you and listen to you. But even before that, reading the documentation is a learning experience. So coming in as a passive investor, but asking those questions is a very, very good way to learn and make that decision if you want to get into the more active component of investing in multifamily.
Absolutely. Yeah. And that's the other thing, right? As a passive investor, you get to see a sponsor that you obviously know, liked, and trusted enough to invest with them. You get to see what their process is, literally from cradle to grave, right? So, and I normally never name any of my investors unless they name themselves first. So in this case, since Malcolm, you've outed yourself, we like just take privacy very, very seriously. So since you've outed yourself, you've now seen, okay, from the first email to the second email to the third email to the investment process to the signing process to the wiring process to the distribution to the post-close communications. You've seen all of our processes. And now that you know, when you're actively on a deal, right, you invest as an active investor now, and you can now take that exact process. You don't have to reinvent the wheel. You can copy it. It's not proprietary. I didn't make up emails. So
it's not quite plagiarism, but
I mean, it's only plagiarism if I complain about it, I think. And I am an abundance mindset. There's plenty for everybody. And I'm all about efficiency. So if you can get efficiency from using one of my processes, what do they say? Like, imitation is the highest form of flattery. So go for
We're
it.
going to flatter you like crazy. Yes.
I love it. Do it. You are being given express permission, Malcolm.
Thank you very much.
You know, for newer people that are, you know, trying to get into it, one of the things that's a good way to, on the active side, is to try broker outreach and then, you know, bring a deal to a more experienced team. And that's something that Justin does a show on several times a week, where he does broker outreach and helps other people do broker outreach. If you were going to start doing that, how would you pick a market? And also, I wanted to ask you about faking it until you make it a little bit.
Okay. Yeah, you want to like really zero in on that, huh? Okay. So how do you pick a market? I mean, am I gonna like create all these competitors in my markets now? No, just kidding.
Well, no, you'll tell them right now to bring the deal to you if they get one.
Oh, then yes. If I'm creating collaborators, I'm here for this. No, I'm totally joking. So we look to markets that we understand the fundamentals of very clearly. And listen, money is made in every market. So this is by no means the only way to do this. This is just how we do it. Sure. What's more important than which market you're in is the strategy behind it and really understanding it, and also staying focused. Do not go and try to make offers on 100 different markets. You will not know them as well as I know our 7 markets, right? So, and then anytime we come out with a new market, it's a market that we've been looking at for at least a year, if not probably closer to 2 years, and we've been underwriting it. So we will just spend 12 months just looking at a market to see what it does, how it performs, how is pricing, what are brokers looking at. We'll build those relationships with brokers over, I literally mean a year. And this is, people are often surprised because they think like, oh, this is like so glamorous and sexy, but this is the unsexy side of the business, right? Like this is the hard work side of the business. This is the patience and perseverance and determination side of the business. And so we look to markets that have very diverse job sectors. So we like markets where there's significant number of employers in various sectors. I don't want to see just oil and gas jobs, right? Like I want to see hospitality, and I want to see tech, and I want to see finance. I want to see many different sectors which have either regional or global or national headquarters or major offices there. I also am looking to see migration patterns. So you can look up migration patterns to see where people are moving. I also look in states that are landlord friendly. My family actually used to invest in Illinois, which is, depending on which county you're in, is very tenant friendly. And it can put you upside down on an asset sometimes because you could be in the middle of an eviction for a year. Whereas in the states that we're invested in, like in Texas, you can have a non-paying tenant out in 21 days. And so you want to be in states that are going to coincide with your level for risk tolerance. And if you're going to be in a state like Illinois or California or Oregon or whatever, right, you want to make sure that you are underwriting for that risk that's there. So it's okay. I tell people, I don't care if I have a $5 million roof repair that I need to do on that doesn't bother me. It doesn't scare me as long as I know about it ahead of time, because that's going to affect my numbers. It's going to affect how much I'll offer. It's going to affect how I'm going to operate it. It's going to affect what projections I'm going to put out. So all those things get globally affected. So as long as you know about these things, it's okay. So those are how we kind of look to our markets. Right now, we invest in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona. Those are the markets that we are looking in actively. There are a couple of other markets we've been looking at significantly. We have not yet made our foray into them. I don't know if it will happen or not, but we're definitely looking at those markets.
Yeah.
Fantastic.
And I'm sorry. Go ahead, Malcolm.
When you said you take a year to get into it, but I'm just curious, what was your first multifamily property, and how did you get into it? Was that a more aggressive approach at that point in time? I mean, you're learning yourself at that point in time. I'm sort of curious about that.
Yeah, so I had a partner who was much more experienced and really brought a lot of strength to the deal. And so it wasn't super aggressive. We bought it for $15.9 million and we sold it, I think it was like 3 years, 3 months later. And we sold it at like 24 million-ish, which, that's a much smaller deal than we would even look at today. If we were going to do, $16 million property today or a $25 million property today, we likely would just buy it in-house or just, a couple of friends, and we probably wouldn't actually put it out to our investor database because it's just too small of an asset to do all of the work for. But that was at that time, it felt like a very big asset. And I think when you're initially starting out and you're partnering, a lot of people are very, they're protective of the equity in the deal, right? Like they don't want to give up equity. They don't want to give up too much equity. They want to keep it. But the reality is if you're going into a deal with an experienced partner, there is almost zero incentive for them to come in and help you with the first deal, just from a pure bandwidth perspective and a risk perspective, right? And so it is going to be expensive to have an experience. The person that you want should cost you a ton of equity and money and maybe even your fees. But the thing that's important to remember for new investors, right, is don't be afraid to give up all of the deal. Like, you just need a very, very small slice, because it's not about the money that you make from the deal. It's about the fact that now you are a sponsor on this deal, because that is going to help you when you go to get your second deal, your third deal, your fourth deal, and it gets exponentially easier as you go along. Initially, the first deal is always the hardest deal. I mean, I cried myself to sleep every night for 6 weeks when we were raising that deal, because I thought we weren't going to close it. I thought we were going to lose a whole bunch of money.
Yeah, I'm not certain how much we're allowed to say. We've got an LOI under negotiation at the moment, and I'm feeling those stresses at the moment. So it's good to. I'm sorry that you cried yourself to sleep, but I feel better to know that that I'm not alone.
It's funny that you say that, because I think I've been saying this a lot more recently, because I've realized how many people need to hear it, because I needed to hear it. Entrepreneurship and this business especially can be very isolating. It can be very lonely, because people who are not in your shoes, who are not in your GP, they don't necessarily understand the stress and the pressure that you're under. Because a lot of times on these assets, we put $2 million up day one, and that's to be lost if we don't deliver and we don't close, right? And I mean, that's not an insignificant amount of money. I'd be pretty upset if I lost $2 million. I'm willing to lose it. I'm willing to take that risk, but I don't want to lose it. I can think of a lot of things I can spend $2 million on rather than just losing it. So those are things to just consider as you're going through this. all of us have gone through some version of whatever you're going through. Anybody that's done a deal, and it's hard. It's really, really hard. And honestly, you might even fail on your first one, and that's okay, because even if you fail to close, you're going to learn so much just from being in the process that it's still worth it. And even if you lose a little bit of money, it's that education that you now have will be invaluable as long as you stick with it. If you fail to close the first time and then you quit, then it's just a loss, and that really sucks. But if you stick with it, it will come back to you tenfold.
Yeah, no, I'm committed now, and yeah, you're very right. I've learned more in the last 3 weeks than I guess years of previous real estate investing. It's just it's drinking from the fire hose, and it's amazing. It's fun. It's scary. It's all those emotions all at once, you know. So.
Yep, I know exactly how you feel. And, I'll tell you to settle right into this, because it does not ever go away. You are always going to have this, like, what are we doing? Like, do we know? Can we do this? Like, should we be doing this? I still have that to this day. And we've closed on hundreds of millions of dollars of properties. And I'm still like, so am I qualified to be buying this deal, or like what's happening? So there's always those moments of self-doubt, but the reality is you will find your groove. You should always be a little bit outside your comfort zone. Otherwise you're not growing.
Oh, absolutely. Thank you.
Yeah, that's tremendously encouraging. And it's been definitely a roller coaster for us as we're starting to experience some of these things. But like I was telling the group yesterday, it's quantum leap they're learning, just like you said. I mean, a lot of the stuff we've heard before, but until you're sitting in a room with a securities attorney and he's starting to explain this or that, and it's, your bottom's on the line. That's when it starts to stick.
Yeah, and you're like, what did I sign up for? Wait, what? I'm doing what now?
No, your time is super, super valuable, and we don't want to abuse this gift that you've given us of your time. We have a lot of interaction in the chat, and a lot of people wanting to ask questions. And so, do you have time to answer a few questions for our audience?
I actually think that, well, let me just look at my calendar, because I think I actually have a little bit of a gap here. So we are good to go.
Oh, awesome. Thank you so much. And I'm sure our audience is gonna be super appreciative. I don't know if you've been able to see any of the comments as they've been coming up, but people have been singing your praises the whole time through. They're really excited to get to interact with you through this medium, and we're excited for that as well. Yes. I'm going to bring up Nicole's question. Hers was the first that I saw. She asks, what's the best way to fund deals in rural areas, existing multifamily or development opportunities?
Oh, okay. So this is a good question. And she's going to hate my answer, because she's going to think I'm going to be like, oh, it's obviously existing multifamily, because that's what I fund, right? But that's actually not true. The answer is it depends, which I know I sound like an attorney, and I am not an attorney, but it depends. And here's what it depends on. It depends on who are your capital sources, right? So if your investors have a risk tolerance for new dev, which has a higher return potential and a higher risk profile, then you will probably find it easier to have investors that go into new dev. But if you have investors like me who are very risk averse, they want like conservative, solid returns, but I don't need a home run every time, then existing multifamily is going to be easier to fund. So really what you need to do is go to your investor database or your potential investor database of who you think you're going to raise funds from. Ask them. Say, hey, these are the 2 different projects I'm looking at, or these are 2 different examples of projects I'm looking at. And I want to just get your feedback on what you think and see what they say, because they'll tell you, they'll say, oh, yeah, I want this really high return, but I want the risk profile of this low return asset. So put them together, and then you have the asset I want, which, then you can have your education moment where you say, no, it's risk adjusted return. Are you at a point where you take on more risk to get a higher return? Generally, too, the closer to retirement age that you find your investors, so the older your demographic, the more they're going to look for existing opportunities or lower risk opportunities versus those higher risk opportunities. Because once they're retired, they're really usually in sustain mode. They're not in growth mode anymore.
Excellent, excellent. Julie asks, she says, how do you determine area cap rates to use?
So the area cap rates, that's kind of what we talked about a little bit, right? So we talked about looking at your markets. When we're looking at markets for a year, we see the trend over a whole entire year of what market cap rates are. You can also find historical data on what something actually sold for or traded for. They will put out press releases a lot of times saying that. So you can go and you can find out how much an asset is actually being purchased for, and you can work backward from there and say, okay, when I looked at the T12, it was $1 million. They paid 10 million. The cap rate is 10%, which is not realistic, and that never happens. So that means there's an error in your calculation if you come up with a 10% cap on Class B assets.
There's just to add to that. There are a number of sites that give cap rates for areas. What do you see? How accurate are those sites in your opinion?
I have not seen those sites, so I would not know. There, you mean there's like a?
I think apartmentinvestor.com or something like that.
Yeah, apartmentloanstore.com is what I teach folks to
like
use.
Okay, market reports. Yes. Okay, so yeah, those are usually going to be pretty good indications. You can go and look at some of these numbers and statistics from paid licenses, like on Axio and CoStar and Yardi and all of these paid licenses. You don't necessarily need to do that. These are very expensive. Probably not really something a beginner necessarily wants. And maybe you should actually talk to operators and sponsors in the area. Ask brokers, what's the going cap rate for that area? They'll tell you, because brokers want you to buy assets, and they already know if they're going to get you in at like a 2 cap in a market that's a 5 cap, you're eventually going to figure it out and you're not going to close, and then they're not going to get paid.
Great point.
So
Joel asks, he says, I've been seeing lately people adding 1% or more extra to the market cap rate in their underwriting to adjust for the rising interest rates. Are y'all doing similar calculations?
yes, we are. So what you're actually talking about is an expansion cap rate on an exit assumption. And so what you're basically trying to say is we are going to be conservative and assume that cap rates are going to continue to expand. Now, in our markets, they really don't move by this much in the course of 5 years. 5 years is our general plan hold time. And it's a relative to other investors, it's actually a pretty short time horizon. So if cap rates are moving at 1% in less than 5 years, like that's significant movement. And we probably have other things that we should be worrying about instead. But I would say on average in today's market, like an extra 7 to 10 basis points per planned year of hold is like typically a good rule of thumb to follow. So if you're going to hold it for 5 years, an extra 0.5 point or 0.5% is fairly standard to follow. What you really want to be doing, though, is running what's called a sensitivity analysis. A sensitivity analysis says, okay, if we exit in 5 years at a 5 cap, what is the cash on cash or IRR to our investors? Really, the IRR is the metric you want to look at. And then you can say, okay, if we exit at a 5.1% cap, what does it look like? What about at 5.2? Okay, what if we do really well? And what if it goes 4.9? What if it's 4.5? So it's basically a table that you come up with that shows you all the different scenarios that could potentially happen. And you can look to that to say, okay, what's the worst case scenario? What's the best case scenario? And what's kind of the base case scenario?
Yeah, that's great.
Julie asks, is being a fund manager complicated, and what are the requirements?
Yes. All yes. No, listen, it would be like me asking you, is it complicated to change brakes on a car? I mean, for me, yeah, because I don't know what I'm doing and I've spent 0 time trying to learn it. For someone who went to like auto mechanic school, is it complicated? Probably not. It's probably like, oh yeah, no, you go and do it. So it's not a fair question, Julie. So it is not for the faint of heart. It's not something to jump into lightly, but there are plenty of people that do it and do it successfully. Anybody could potentially do it, but you have to make sure you're taking the right steps to do it. You want to reach out to a securities attorney. I think when Malcolm called me on this latest deal, I was like, the first call should not even be to me. It should be to Nick, right? Like Justin and Malcolm reached out to me and I was like, nope, first call is to Nick, your securities attorney. I still call Nick when we have a deal that even looks like it's potentially going to be accepted. He's my first call. My next call is to our tax strategist. So, you know, I call Nick, hang up the phone, call Larry, and that's like that is my process right away. As far as what the requirements are, it depends. I know you guys hate these answers, but it so depends on what you're trying to do. And because I'm not an attorney, this is not legal advice, but generally speaking, you're going to want to know, how are you going to raise? Are you going to raise under an exemption? Like, what's your securities exemption you're going to use? Are you going to use the Reg D exemption, Reg CF, Reg A? There's so many different options. Most people in real estate are going to use the Reg D, and then they're going to either use a 506C or a 506B raise, depending again on who your investors are, how you're going to raise capital, what you need to be able to do. What is, what's the database? What do they look like? What are your investors' tolerance? Do you need to be able to talk about it on a podcast, right? All of those are going to impact how you're going to raise your capital and what your regulation or exemption you're going to rely on is. The reason it's important to call someone like Nick first is because, one, the securities rules always change, and two, and more importantly, some of the regulations like Reg D 506B, like boy, you cannot raise capital. Once you have a deal on the table, you cannot raise capital in public. You have to have a pre-existing substantive relationship with every single investor. And someone might say, well, why would I do that? Well, you might have enough of an investor database. That's one. Two, you might need to take up to 35 unaccredited but sophisticated investors into your deal. And that regulation allows you to do that. And so there are different reasons to use different regulations, especially when you're starting out. You want that guidance, and that's what your securities attorney is going to tell you. So Nick usually will send, I don't know if he sent you guys that questionnaire he sends, but he'll send you a questionnaire and then he'll give you additional guidance if he thinks you need to do a certain raise, or if you chose one and then you really should be doing another. He'll guide you through that, and that's part of his role in your team.
Yeah, we do have quite a few more questions, but we're reaching the top of the hour. So I want to, and I'll do this throughout, just keep giving you subtle pitches so you can let us know so we can appreciate your time.
Yes, absolutely. I think I can do like maybe another 15 minutes or so. And then are these questions in the Facebook group?
Some of them are going to be in the Facebook group. We've asked for most of them to come on over to the YouTube channel because it's easier for me to get them there. So, and if you guys are in the YouTube channel, please take a moment to like and subscribe, help us to grow this channel. And hopefully we can continue to bring you good, valuable content like this and amazing guests like Veena. Man, Veena, we are so thankful to be able to have you on here. And folks are just loving on you in the chat. Monique says, Veena is giving so much multifamily gold, and she's clearly correct there.
Well, I'm glad I can earn my keep. But what I'll do is, if there's a lot of questions still left at the end that we don't get to, I'll try to go through and answer some of them on YouTube or the Facebook group.
Oh, awesome.
Oh, that's so awesome. So guys, you heard that. If your question doesn't get answered here, please continue to make those. And also, if you haven't had a chance, please look up, what's the name of your new Facebook group, Veena?
Oh, yeah. It's called Mastering Multifamily with Veena Jetti.
Mastering Multifamily with Veena Jetti. Now, when you do sign up there, make sure that you click the box that says that you'll follow the rules, or you'll be denied access. And I think I tried 2 or 3 times before I finally got in because I'm exaggerating, but
high bar here. You got to follow the rules, okay?
but understand, if you don't.
I was gonna say, it's a good thing you got in, because you saw that I just posted the sign up for the investor challenge.
Yes, and I quickly signed up. I can't wait. I'm super excited.
I'm excited about that too, actually.
So Dustin asks, he says, question for Veena, what
Oh,
interest rates are they seeing right now for the asset class? Uh,
no,
they're
don't ask me. Don't ask me this question. It's too painful to answer. Right now, well, day before yesterday's hike, we were seeing like around 6-ish%. I think that the Fed is going to raise interest rates again. So I think it's very likely we get up to 7-ish%, which is just crazy. I actually was at a conference. I was speaking at a conference in August, and Cody Sperber, clever investor, was one of the other speakers there. And he's a friend of mine. He like got up and I listened to him talk. And then after I caught him in the green room, and I was like, Cody, like really 8% interest rates? You sound like a crazy person and like you don't know what you're doing. And he was like, maybe I'm wrong. I hope I'm wrong, but maybe I'm right. And I was like, all right, we'll see. And so this was just in August. And so now I'm going to have to eat my words next time I see him because I'm pretty sure he was probably right.
oh,
You just need to go back historically. You need to go back and look at what happened in the 1980s and 1990s.
Yes.
Yeah, I have a weird background. My mother used to work for the Department of Economic History at the Australian National University, and so I
Okay.
have economists and weird economic facts and thoughts in my head. But now I actually understand why you want economic history. So anyway.
Yes. Yes. Because you want to know, okay, we should really plan on this because it's possible.
Yeah, exactly. So, yeah.
One thing I'll say too about interest rates is we're now seeing agency debt or fixed rate longer term debt underwriting at much better numbers for our LP investors than we've seen in many years.
Can you clarify what that actually means?
Yeah. So in the last like 2, 3, even like over the last 5 years, really, underwriting with agency fixed rate debt has not made a whole lot of sense because the defeasance or the yield maintenance, like your exit or disposition fee that you have to pay to get out of the loan, is so astronomical. You couldn't take advantage of the compressing cap rates that we were in without paying a hefty prepayment penalty. And now we are in a moment where it's like it's kind of pricing out better and it's lower risk and it's better for investors. We are not variable on our rates. So we're now going into fixed rate debt. Whereas even 6 months ago, that wasn't really a concern at all. And even 6 months ago, we're a little bit more on the conservative side of how we look at deals. And so we were buying down rate caps. So we bought rate cap insurance where our interest rate can never go above a certain threshold ever because we paid for that, right? That insurance. And I mean, needless to say, our insurance has kicked in because we have adjusted above that very quickly. But it's important to just note that if you're going into variable rate debt, make sure you're looking at your interest rate caps. It's very important, especially right now, especially if you're a newer sponsor. And then you should also be pricing out long-term or fixed debt.
So agency, you mean Freddie Mac and
Fannie Mae, yeah.
Right. Okay. Yep. And then the alternative is really the banks. And while you're talking about finance, I think I'm hearing this from doing the work I'm doing right now, but there was a lot of money that used to come in through funds and stuff like that. That seems to have dried up.
No, I think you're talking about like life insurance trusts and stuff like that.
Those sorts of things. That's what I understand.
No, we're still seeing those. The problem is everybody's interest rate is, everyone's paying the Fed rate plus whatever their spread is. So it's just expensive, and not the Fed rate. I think now the standard is pretty much the SOFR. Everybody uses the SOFR rate as their base rate plus whatever their spread is. So when I say agency, I mean like Fannie and Freddie. When I say variable debt, I really am talking about like bridge debt or short-term debt. It doesn't necessarily have to be a bank loan. CMBS does that. I want to say that Fannie and Freddie may have a product like that. I've never borrowed it though, so I don't actually know. We always do fixed rate debt with agencies.
Fantastic. Thank you.
Yeah.
Dustin follows up that initial question with another question for Veena. If the cap rate is lower than their interest rate, are they passing, or is the deal based on how much upside there is?
Yeah.
According to
So
their business?
this is actually an awesome example of something I meant to hit on earlier, and then I got sidetracked. But I think investors put too much focus on cap rate in general, because a lot of people would say, "Oh, the cap rate is below the interest rate, we're not going to do it." But what really matters is your blended cost of capital and your operating cap rate, right? So if I can buy an asset at a 4 cap and in a year move it and operate it at an 8 cap, am I going to buy that deal? Probably all day long, right? What you want to do is you want to look at many cap rates. You want to look at, where is the seller exiting their cap rate, right? Where are you acquiring it? What's your adjusted cap rate? When you adjust for taxes and insurance, what's your cap rate then? What's the market cap rate in the area? What's the sub-market cap rate in the area? What's your operating cap rate? What's your exit cap rate? Are you guys tired of me saying the word cap rate? Like, this could be a whole drinking game, right? Like, every time I say the word cap rate, take a shot. Because there's so many different variables. So it's not just any one metric. And then again, going back to the sensitivity analysis, you really want to stress it and see what it looks like on the conservative, the optimistic, and the realistic models.
Perfect. Thank you.
So,
Our audience is definitely quite mixed, and so we have Michael with a really beginner question.
I love it.
And he just asks, it may have already been answered, but what is an OM?
Yeah. I love these easy questions, and I always tell people too, because I think sometimes people get intimidated by discussions of all these cap rates we just talked about, right? And they're like, "Oh, I don't want to ask this question." And Michael, I'm so appreciative that you asked this, because I always tell people, like, the only stupid question is the one that you did not ask, because everybody has thought this question or asked this question either before or has it right now, and you actually asked it, so we can answer it. So an OM is simply an offering memorandum. It is just a pitch deck, a marketing deck. It's a fancy word we use. I don't know why we use this fancy word instead of just saying it's a marketing deck or a pitch deck. So this is really going to be a pretty version, a brochure, something that you're going to present to investors. Sometimes people do an executive summary or a one pager. Our OMs are like 60 pages long. They're pretty long, but we get a lot of really great feedback when we have more detail. We've tried it with like a 20 page. We've like tested different versions to see, on each deal, which one gets the best feedback, and the longer ones with more information generally do. So we just keep all that information in there, but it's going to tell you all the basic stats about the asset. It's going to have pictures. It should be pretty. It'll be polished. It'll tell you about the team, the strategy, how we arrived at our conclusions, your pro formas, all of that will be in there. Your return projections, all of that will be in your OM.
Very cool. I'm just searching for the next question right now as I'm going through all the lists. So if you've got your questions, please ask them. Joel asks, what do you guys look for in terms of IRR and returns for your investors?
Yeah.
Usually the structure is 80-20 between investors and the GP. What returns do you usually get for both?
Yep. Okay. Love this question. So this is what is going to be called your buy box, right? So our buy criteria is very specific. We need to hit a 12 to 15% investor level or net to investor IRR. Otherwise, we won't do the deal, because our investors they don't want deals that are lower than that. And that's at least the market we're in today. There was a time where we would look at 15 to 18%. And there was a time before that we even looked at, dare I say, 20 to 22%, right? So knowing who your investor database is really what's going to drive that. It shouldn't be based on what we look for or what we do. It's going to be, who are your investors? Maybe you have a family office that says, hey, give me 100% of the depreciation benefits, and I don't care if you get me a 10% IRR. Doesn't matter to me. Japanese investors, they get massive tax breaks if they invest in, I think it's like 90s construction or newer with wood frame, right? So it depends on who your investors are. That's what you should be looking for in terms of your IRR, because if your investors are willing to tolerate it, then it doesn't really matter what my return projections are. It matters what yours are. Right now, we're at around a 12 to 15% IRR. We're anywhere from 1.4 to 1.6x equities. Equity multiple is a solid deal for us on a 5-year horizon. And we're looking for that 14 to 16% average annualized return. As far as the structure goes, I find it interesting that you say usually, because I think it depends more on who you're speaking with, right? So we've never done a straight 80-20 split on our deals. We always do what's called a preferred return first. So that's our first hurdle. So, and tell me guys if I'm getting like too technical or in the weeds, but I want to kind of walk through what a waterfall is. Is that okay?
Please.
Go for it.
Yes. Okay. All right. Waterfalls. So this is a fancy word to describe how the cash flow moves through the common equity or LPs or passive investors in the deal, and then how it moves through the general partnership equity. The first return that we do is what's called a preferred return. And our return, I'm going to just use one of our asset classes as an example. So the first return is going to be 6%. What that means is if you invest $100,000 into my deal, I am going to give you 100% of the cash flow until you get $6,000 back in your pocket. After that, then we go to a 70-30 split. So we give 70% to the investor and 30% comes to us. That's our promote. That's our fee. That's the second hurdle in our waterfall. The reason we do a 70-30 is because we already give you 100% of the upside until you reach your 6%. So we're already insulating you against downside risk there in that very first tier and very first hurdle. We do it. It aligns our investors very nicely with the general partners, because then our investors know that 6% is kind of the minimum threshold for us to even start getting paid. So it's likely that what we're seeing is we're going to see numbers above that, because I do a lot of charity work. I do a lot of philanthropy. This is not it. This is my business, right? This is our for-profit business. So then we go to 70-30. Then we have what I like to call a home run hurdle. It's a little name I gave it, because it's when we hit a home run, investors are happy to pay more because we have overperformed significantly. So let's say at a 12% IRR, usually the second hurdle is at some kind of an IRR metric. It could be at anything, right? It could be at an equity multiple. It can be at an average annualized return, whatever it is, right? For us, it's at an IRR. So at a 12% IRR, every dollar after that then gets split 50-50. So you take 50%, I take 50%. What this does is it incentivizes us as the sponsor to continue outperforming on this asset. I've invested as a passive investor into deals where it's been like an 80-20 split or some kind of straight split with no pref and no home run hurdle too. And what happened was when the asset started going through more turbulent times, the sponsor started focusing on new acquisitions instead of focusing on this struggling asset, because there was more money in them going after a new asset and getting fees on that asset than there was in focusing on the asset I was already invested into. So part of that experience for me has kind of made me sensitive to the structure. And so that's why now I always like to see a hurdle of some sort or some kind of downside protection for our LPs, because I want them protected first, because that's the lifeblood of our business. If we don't take care of our LPs, then I can just stop doing deals because no one's going to write me another check, right? So we always look for how do our LPs get affected? What's the best thing for them? What's the best decision for them?
Fantastic. Really
Love
fantastic.
it. Well, I think we probably have just time for maybe one more, according to your 15 minutes extra that you've given us. And we so appreciate it, Veena. Thank you again so much. I'm going to just, I think Joel again had another good question that I think I want to put up here.
Sure.
Joel asks, and I might want to put it in my own words for you as well. He says in his question, so if we come into a deal GP side, but as a learner on the GP side. So say we've brought that deal in, we're not getting a bunch of equity out of that position, but we are getting a seat at the table so we can learn. Are we then allowed to invest in that deal without being an accredited investor?
Oh, this is like such a technical legal question that actually involves recent changes to securities rules. Like this change happened in the last 18 months, maybe. The answer that I want to say, as not a lawyer at all, with no knowledge of securities laws or rules, right, is yes. If you are a general partner, if you are a knowledgeable employee and or issuer on the fund, it can make you accredited for that specific fund. So my answer is yes. I hope Nick is not watching this because I will phone call shortly after this. But this is a question to ask your securities attorney, but I think the answer would be yes. And then you could invest your funds into the fund that you're issuing the security in.
Wow.
Veena, thank you so much for giving us this time today. Thank you so much to all of our viewers. We love you. We do this show for you. We hope that we've been able to provide value for you today. Remember, tomorrow evening at 5 p.m. Pacific Standard Time, 7 p.m. Central Standard Time, we will be having a special edition of the Grow Giver podcast. And our guest on that show is going to be Pace Morby. And we're super excited to get Pace on here and to answer your questions and to interact with you. But I don't know. Pace is going to have his work set up before him to try to, he's probably thinking right now, man, I've got to follow Veena.
It's definitely not true at all. Actually, Pace and I, we are doing a in-person masterclass on Monday and Tuesday next week in Dallas. He is bringing out some of his investors that are coming into our deal that we're closing on by the end of the year. We have 2 assets, and we're going to do like an intensive masterclass. And I assume Pace being Pace, he's going to put it on YouTube or somewhere accessible for his people. I don't know how all that works, but I know it'll be accessible somewhere. So, but I'm gonna definitely try to join in and see if I can watch. No pressure or anything, Pace.
Well, feel free to drop in and ask him questions as well.
Yeah, should I ask him? Should I bring like a bunch of really technical questions and be like,
yeah.
Should we punk him like that?
Yes, absolutely.
Sounds really great.
The whole audience that's here right now will be in on it too. He'll be the only one.
I love it. Oh my gosh, that's funny.
I just wanted to go through and give some love to some of these great comments that are coming in for you, Veena, and also, let our audience here just sort of express themselves. They are really having fun with us today.
Yeah, they had great questions today.
Yeah, really good questions.
Really great questions. I'm excited about
you can tell that these are people that are all planning to actually do it. Because a lot of times I'm on these podcasts and they're like, okay, don't really care. Okay, what's an IRR? But like these were very technical questions. So I love it. I think that you guys are going to be very successful. And this is the biggest opportunity that we are going to be coming up on in our whole entire lifetimes.
Yeah. No, it's a great environment right now. It's amazing. And get into the team sport. I mean, we never got to that question, but I know that you work with your sister and you have an amazing team. Like I'm so lucky to have found these guys here as my team. But people just need to go out there and team up, get together, work it out. It's a great environment. A recession, which we're about to have, is going to be a great time to get yourself going, which it's scary, but it's going to be a great time.
It's true. And when you have partners, you can call them and cry yourself to sleep together. When you're
Get on a Zoom and have it out before you hit the hay.
Yeah, you're like, guys, we need to meet for virtual happy hour. Like it's 2020 again, right? And then you just like, what did we get ourselves into? But
Yes, yes. What are the marks on your shoulders? They're stains from the tears. No,
Yeah.
thank you guys. It's been a fantastic show. Again, tomorrow pace, later this week, Wednesday. This week, we are not having our normal Friday show, which, like today, we're doing a show on Wednesday because Steve and I are going to be in Phoenix for the mastermind this upcoming week to hang out and get to meet some of the new breed of mastermind students in the Sub 2 community. And so we're going to be having the show on Wednesday, and we've been privileged to book Tyler Townsley and Eddie Marin, the Bash Brothers, and we're excited to have them express. We're going to be talking about strategies for success in real estate investing. So that should be a fun show as well. Thank you, everybody, for being with us. Thank you again, Veena, for
Thanks, everybody.
the time
Thank
you've
you
given
so
us.
much. Thank you.
Yes,
And-
thank all of you guys for having me and for you guys for your great questions and listening to me geek out on multifamily.
Oh, it's been our privilege. So without any further ado, I'm going to go ahead and give our guest a break. And so thank you all. Remember to go in and join her Facebook community, which is Mastering Multifamily with Veena Jetti. I got it right? Okay.
You got it right. I mean, I sometimes get it wrong, so good job.
And Veena is going to be doing a challenge pretty soon. You'll want to get on there, find out about that. There'll be homework. You'll get a chance to
Yes.
learn from the master yourselves. And I'm super excited. I'm already signed up. So folks, have a blessed rest of your Friday. And we will see you tomorrow at 5 Pacific Standard Time, 7 Central Standard Time. Until then, bye for now.